What's up, you guys? It's Will here. And today, I'm going to delve a little bit deeper into the stock market. And I think it's time we tackle a question that's been on everyone's mind lately. Are we living through another stock market bubble? Think about it. The market just hit all-time highs. Valuations are stretched. AI stocks are being called the next dot-com frenzy. Meme stocks are somehow making a comeback. And everyday investors are piling in, hoping not to miss out. It feels exciting, but at the same time, it feels a little scary. So let's break this down together. I'm going to walk you through whether we're in a bubble, what history can teach us about market crashes, and most importantly, how you can prepare so you don't get wiped out when the next drop hits. Because make no mistake, there will be another drop. We can't predict the exact day or month, but every investor should know what to watch for and how to stay profitable through it. Now, here's the first thing I want you to understand. The stock market goes through cycles. And right now, a lot of the warning signs are flashing red. The Buffett indicator, which compares the total stock market value to the overall economy, is sitting at more than 200% of GDP. That's higher than during the dot-com bubble. The S&P 500's price-to-book ratio, it's above 5. To put that in perspective, during the height of the dot-com bubble, it peaked around 5. We're already past that. And it's not just the numbers. Look at behavior. We're seeing the same speculative energy we saw in the late 90s. Investors chasing stocks not because of fundamentals, but because they don't want to miss out. We saw this during the NFT craze, during the crypto boom, and we're seeing it again with AI. Companies that barely make a profit are being priced like they're going to change the world tomorrow. Most people get it wrong. A bubble doesn't mean the market will crash tomorrow. Sometimes bubbles inflate for years. What it means is that risks are building up. And when something triggers fear, whether it's a Fed rate hike, geopolitical conflict, or disappointing earnings, the entire house of cards starts to shake. So, is that happening right now? To answer that, let's look back at history, because every single crash feels unique in the moment, but the patterns are surprisingly similar. In 1929, cheap credit fueled a buying frenzy until one day, the momentum stopped and the market fell 83%. It took 25 years to recover. In the 1970s, US went off the gold standard, inflation exploded, interest rates spiked, and the market lost 40%. In 2000, we had the dot-com bust, where internet stocks collapsed by 78%. And of course, in 2008, we had the financial crisis, triggered by risky mortgages and bad lending practices. Banks failed, the stock market fell nearly 50%, and millions lost homes. And yet, every single time, the market eventually recovered, which means the real lesson isn't to predict crashes, but to prepare for them. Now, let's bring this back to today. The Federal Reserve has kept interest rates higher for longer, and borrowing costs are near decade highs. That means companies are paying more to finance debt. Households are paying more for mortgages and credit cards, and liquidity in the system is tighter than before. At the same time, the S&P 500 has soared, driven mostly by just a handful of mega-cap tech stocks. That's not healthy, broad-based growth. That's concentration risk. And what worries me most is investor psychology. People are forgetting risk. The longer the market goes up, the more people assume it can't go down, but always does. And if you're not ready for it, that's when mistakes happen. So what can you do? First, you need to shift your mindset. Instead of asking, will the market crash? Start asking, if it does, am I ready? That's the question pros ask. And being ready means 3 things. 1, you need cash. A 3 to 6 month emergency fund ensures you're never forced to sell at the worst time. 2, you need diversification. Don't just load up on the same 5 AI stocks that everyone's buying. Balance your portfolio with bonds, real estate, international equities, and even a little exposure to alternative assets like Bitcoin or commodities. And 3, you need consistency. The data is crystal clear. If you just keep investing regularly, even through downturns, you come out ahead. Missing the top 10 rebound days over a 20-year period can cut your returns in half. So don't try to time the market. Just keep buying in. But I know what you're thinking. What if this time is different? What if the bubble bursts harder than before? And here's my answer. History says it won't be different. It will feel different, but the playbook never really changes. Investors panic, prices collapse, the Fed steps in, and eventually recovery begins. And those who stayed patient, kept buying, and avoided panic selling, they come out stronger. So if you're worried right now, don't see it as a reason to run away from the market. See it as a reason to build your strategy. Because wealth isn't made by avoiding crashes. It's made by being prepared to take advantage of them. So, are we in a bubble? Yes. Valuations are stretched, speculation is back, and risk is high. But instead of fearing it, use this knowledge to get smarter. Build your cash reserves. Diversify. Stay consistent. And above all, don't panic when the next correction hits. Because while a bear market might cost you 30% on paper, the bull market that follows historically gives back 150% and lasts 5 times longer. That's the truth banks won't tell you, but now you know. If you found this video helpful, hit that like button, subscribe for more finance insights, and let me know in the comments. Do you think we're in a bubble right now? Or is this just the beginning of another bull run? Thanks for watching, and I'll see you in the next one.